What happens when someone tries to shrink a taxable gain with a story without the paperwork to make the story stick? In this one, we start with a number that's already been accepted, about 19,000 of capital improvements. Then the claim gets bigger, roughly 95,000 of improvements. The timeline stretches from August 1992 to 2015, about 23 years. The request grows by around 76,000, and at the end, the court sticks with about 19,000, meaning 76,000 of that increase never makes it into basis. A classic tax court theme: proof beats confidence. Hello, everyone. My name is Dvorkin. I'm a certified public accountant in the state of California. And if you like this kind of real-world tax storytelling, please like this video and subscribe to this channel. This channel reviews and analyzes U.S. tax court cases to understand how U.S. tax law works. This video, we cover tax court decision in the case of Tibor Gyarmati versus Commissioner of Internal Revenue, decided on March 26, 2026. The cast is fairly tight. The main character is the taxpayer who lived in Michigan when he filed his tax court petition. The opinion says he is married and has 4 children, and that his primary occupation is owning and operating several car dealerships, including at least one in Michigan. The opinion also adds a detail that matters later. He was licensed by American Society of Interior Designers, which let him buy furnishing at wholesale prices, about 40% less than retail. So, over the years, he bought significant amount of furniture, mostly for personal use, and sometimes stored purchases at a dealership with substantial storage space. Now the property at the heart of this dispute is the Florida condominium, the Florida condo. The opinion says the taxpayer and his wife bought it on or about February 1989 for about $410,000, and it was unfurnished purchase. It was around 3,000 square feet with a pretty full layout. Multiple living spaces, balconies, 3 bedrooms, and 3 bathrooms. The opinion says the condo was remodeled several times during ownership, and also that the family fully furnished it, listing examples like custom-made wall unit with a built-in rear projection television and leather sectional, dining furniture, balcony furniture, and bedroom sets. Then comes the plot twist, with a date you can't ignore: August 1992, when Hurricane Andrew hit. The opinion describes the condo being severely damaged, with hurricane window failing and substantial interior water damage. It says the condo had no power for several days or weeks, and it was without air conditioning. Hot and humid conditions led to mold growth, extensive mold damage to the condo and furnishing. Insurance covered damage to items inside the condo but excluded mold, and the opinion says the taxpayer separately funded mold remediation. The narrative is vivid, but it also immediately signals a problem. The opinion repeats that it's unclear which furnishings were there before the hurricane, which were damaged, which were refurbished, and which were bought later. Fast forward to the family's use of the condo. The opinion says it was a vacation home, visited several times a year, usually for a week or longer, planned around the school year. But the opinion also says the family vacationed more frequently at a ski resort property in British Columbia, Canada, than at Florida condo. Limited use became the push to sell, and in 2015 the condo sold for about $775,000. And here's where the tax trouble starts stacking up. Because the opinion says the taxpayer did not file a federal Form 1040 for 2015, the IRS prepared a substitute for return, certified it on June 30th, 2021, and then issued a notice of deficiency on September 22, 2021. The headline numbers in the opinion are large. The IRS determined a deficiency of about $861,000 plus additions to tax of approximately $194,000 for failure to timely file, about $215,000 for failure to timely pay, and around $15,000 for failing to make sufficient estimated tax payment. The opinion emphasizes these amounts were due in large part to 2015 sale, a Michigan rental property, and a Florida condo. By the time the case is tried and written up, a bunch of items are considered and narrowed. The opinion lists concessions including filing status as married, filing separately, net rental income for the Michigan properties accepted, and gain on the sale of Michigan properties agreed at about $919,000. On the Florida condo, the parties agreed the taxpayer can increase adjusted basis by around $19,000 for capital improvements. And the IRS concedes that net proceeds from the Florida condo sale were about $718,000 after transaction costs of roughly $57,000. The only real battle left is, can the taxpayer reduce the Florida condo capital gain further by increasing basis with more capital improvements and allocating some of the purchase price to furnishings included in the sale? And then separately, can he escape the late filing, late payment, and estimated tax penalties with a reasonable cause defense? The court sets the ground rules in plain tax court fashion. IRS determinations are presumed correct, the taxpayer has the burden, and taxpayer must keep records under Section 6001. The court notes the taxpayer didn't argue for burden shifting, so this is a receipts and credibility case. First, the basis increase story. The taxpayer argued he should get about $95,000 of improvements after Hurricane Andrew, not merely the agreed roughly $19,000. The court's reaction is blunt. We didn't find him to be a credible witness. Then the court explains why in line that lands like a gravel. His testimony was vague, inconsistent, and oftentimes contradictory. In normal person terms, the court didn't just think he was mistaken. It thought his story didn't hold together well enough to rely on. The opinion says he testified that he spent probably around $150,000 remodeling the condo, but he struggled to remember when and how often remodeling happened. He initially gave a sequence of years 1989, 1990, 1992, and 1994, then pivoted to the idea that remodeling was ongoing, including one major project after the hurricane, but the court points out a key weakness. Even with all that talk, his testimony gave very little light on what work was performed in the disputed project. That's the tax court's version of, okay, but what exactly did you do? And what did it cost? Then come the documents. He produced a small set of papers, a sale order for a metal wall bracket, a selection sheet for floor tile, and an order from 2 bathroom light fixtures, with dates spanning 1988, 1989, and 1994. The opinion notes these items were purchased in Michigan or shipped to his Michigan home. He also produced a 1994 order form for a chandelier of roughly $23,000, also to be delivered to his Michigan home. His explanation was that everything was ultimately driven from Michigan to Florida in dealership panel trucks, installed in the condo, and sold with the property. But the court didn't buy it. The opinion says he has not met his burden to prove the about $95,000 increase in basis. It highlights insufficient detail about the remodeling work and that documents show only purchases in Michigan or shipments to Michigan. Then the court drops a line that tells you exactly how the judge's intuition met the evidence. We find it unlikely that the Florida condo was sold with $23,000 chandelier, and the taxpayer could not assure of such. And if you're thinking, well, couldn't the court estimate something? The court addresses that too. It says it can estimate under Cohen only if it has some basis for the estimate. But here it has no reasonable basis to estimate additional improvement. Result, no basis above the agreed total. So the condo basis stays where the case concessions already put it, about $429,000 total, that about $410,000 purchase price, plus roughly $19,000 of agreed capital improvement. Next, the furnishings argument. This is the taxpayer's second attempt to shrink the condo gain. He claimed the furnishings sold with the condo had a fair market value of at least $63,000, and he claimed an adjusted basis of around $250,000 in those furnishings, meaning he wanted the court to allocate about $63,000 to the approximately $775,000 sale price away from the condo itself and onto the furniture. That would reduce the amount realized attributable to the real estate. But the factual record is a mess. The opinion says he testified he didn't have sales contract for the condo and there was no separate bill of sale for furnishings. What he did have were furniture invoices from 1984 to 1994, meaning the furnishings would have been roughly 21 to 31 years old when the condo sold in 2015. The court's view is straightforward. We find it unlikely that a buyer would have given much, if any, value to non-collectible furnishings that were so old. It also notes that many invoices predated the hurricane, so if the furniture had actually been moved to Florida then, it's unclear whether it survived. And it adds a practical point that's almost funny if it wasn't so fatal. The invoices cumulatively accounted for more furniture sets than could possibly have fit into the Florida condo. The court sums up with a line that, from a story standpoint, is the moment the furnishing subplot dies. The taxpayer only knew for certain that about $775,000 was the total price paid. He didn't know the fair market value of the condo itself or the furnishings allegedly sold with it. The court says he has failed to show that any amount of the purchase price was for furnishings. And again, there is no reasonable basis to estimate an allocation. So, no allocation, no deduction in condo gain. With those two attempted reductions rejected, the court locks in the Florida condo gain at around $289,000, combined with the agreed Michigan property gain of about $919,000. The opinion says total gain from the real estate sale for 2015 is roughly $1,208,000. Now for the penalty side. Because this is where the I'll fix it later strategy runs into the statute. For the failure to file and failure to pay additions, the court explains that the taxpayer can avoid them only by showing the failure was due to reasonable cause and not due to willful neglect. And that reasonable cause generally means exercising ordinary business care and prudence, but still being unable to file or pay on time. The IRS met its burden of production by producing the substitute for return and account transcript. Then the court turns to the taxpayer, and there is basically nothing there. The opinion says the taxpayer offered no excuse for his failures to timely file 2015 tax return and to pay the tax due. With that lack of evidence, the court holds him liable for both additions. For estimated tax, the court explains the framework and notes something else that matters. The opinion explicitly states the taxpayer also failed to file his 2014 return. The IRS produced 2014 transcripts and other processing transcripts to show he was required to file 2014 return, but he didn't. He was required to make estimated payments to 2015, but he didn't make any. The taxpayer presented no contrary evidence and made no other arguments, so the court sustains the estimated tax addition too. And that's the ending. The court concludes the 2015 real property gain is about $1,208,000. The Florida condo gain remains around $289,000. And the additions to tax under the late filing, late payment, and estimated tax provisions apply. The opinion closes by saying the decision will be entered under Rule 155, reflecting the holdings and the parties' concessions. If you want the moral of this story, it's that the tax court is not a museum for probably ongoing and we drove it in the truck. If you are going to ask a judge to treat decades-old purchases and post-hurricane renovation as tax bases, you need evidence that ties the dollars to the property, especially when the court is already telling you in plain English that it didn't find you credible. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. If you like this video and found this information useful, please subscribe to this channel and give thumbs up to this video. And I'll see you in the next tax court case review.